Wow, we got questions already. Okay, awesome. Let's get started. Good morning, everybody. Thank you for joining me here on a Saturday. This is what Q&A number 144. I have to write it down because I can never remember. So Q&A number 144. Another interesting week as always. I mean, we live in interesting times, don't we? We talked about this in the last Q&A on Tuesday. I wanted to start with this. Somebody asked why the markets weren't reacting to macro data, and my answer was they are reacting to macro data, just not in the way you would expect. Simply because the narrative has changed. Everything has shifted because of the events earlier this month, and this week's data was a perfect example of everything that we were talking about in the Q&A. Whether it was GDP, the payroll reports, ISM, all of those continue to decelerate and suggest that the economy is heading in the wrong direction. But that was not the market reaction to it. Before we got to April, really April is when it started to shift in February and March, but really April, everybody turned basically apocalyptic. You see it all in the sentiment surveys. Markets were like screaming for bloody murder. And so everybody at that point, the narrative had shifted, perceptions had shifted enough so that everybody was expecting confirmation of the worst case. And that was the only thing that was going to get markets to react because everything was already down. Stocks were already beaten up, financial assets, all that stuff. So if the payroll report wasn't complete, utter disaster, GDP didn't utterly crash, markets were going to take that as, at least in the short run, it wasn't the worst case, so we're going to back away. We went from is the data good enough to is the data bad enough? And so this week, the statistics weren't bad enough, at least for the market in this position, coming back off the lows, which is understandable. So you had GDP that came in. It was slightly negative, but everybody, it was negative, but it was because of the artificial flood of imports. Therefore, it wasn't negative enough to produce the same reaction. ISM, I laughed at that one. Steve and I were laughing at the ISM. The ISM comes in, it was down, it was low, 48.7, I believe, but it wasn't 47 or 46, even though parts of it were down to 46. I mean, the production index fell to 44, but the headline was only 48.7, even though just a couple months before, everybody was looking at the ISM peaking above 50, just barely above 50 in January and February and saying, this is terrific, manufacturing is coming back. Now that the ISM is showing that it was artificial, we are in a payback period, what happens? The reaction to the ISM was, it wasn't bad enough, therefore this is risk on. Same thing with payrolls. Everybody looks at the payroll report and says 177,000. You hear the strong, they throw around the term strong for basically anything, which is absolutely ridiculous. But 177,000 for payrolls, that wasn't bad enough, therefore risk on there. When you look at the actual payroll report, especially with the revisions, 177,000 isn't good to begin with, but then you look at what happened in January and February. Both of those have been revised down substantially. January and February are barely above 100,000. And if you get the same level of revisions, which are averaging a whopping 40,000 negative revisions just for 3 months of this year, you get a 40,000 revision for this April number. What does that put payrolls at? 130,000, which means for the three of the first 4 months of this year, you've got payrolls less than 150,000, and the fourth one is barely 180. So yeah, the payroll reports are actually showing a decelerating labor market, but it wasn't bad enough, so the markets took that as risk on. And just this entire week was that sort of thing. So once you realize and normalize to what the perceptions are and expectations are, it all does kind of make sense. So for us, it's not really about the reaction in the stock market to macroeconomic statistics. It's divorcing ourselves from those emotional swings and saying, okay, what is really happening in the economy here? Negative GDP, yes, there was some artificial negatives from the front running of imports, but that was the point. You have all of this artificial activity, which means there's going to be a payback period, which is the point that Steve made in the video that will come out tomorrow on YouTube, is that the 177,000 in payrolls, the barely 50 in the ISM, GDP that was slightly negative. That's during the period where we have artificial support to the economy. Yes, imports are a subtraction from GDP, but there are other artificial supports, including consumer spending in March that exploded higher on automobile sales. That's all going to be paid back. So we look at the payroll report, 177,000. That's before we even get to the payback period or the tariff shock, the full tariff shock, whatever that's going to be. By the way, I don't think tariff shock is all that big of a deal, and it wouldn't be a big deal if the economy and the marketplace wasn't so fragile to begin with. So what a crazy week it was when everybody took the bad data and said it's not bad enough and went risk on all over it, which is We've gone through these periods before, and that's what happens. Once expectations reset, most often the marketplace goes way too far in the other direction and reset expectations too low, given the constraints that are in the economy today, which is, I mean, we're still getting into the payback period. It's not like flipping a switch. So let's start with the questions. Like I said, thank you for joining me. Q&A 144. Enough of my economic rant here. What is your opinion on the following statement? U.S. Treasuries on the brink of total collapse. Are Treasuries deemed to be safe and a lower risk investment? I think this week, the last couple of weeks have showed that's absolutely the case. People who say Treasuries on the brink of total collapse usually are selling you something or have an agenda. They've been saying the same thing for well over a decade, really going back to 2008 and 2009. Ever since George Bush basically blackmailed the world by saying, if we don't do TARP and completely remove all of the traditional objections to massive government spending, government borrowing, will be Great Depression 2.0. Ever since then, people have been saying, for one reason that's correct, that, you know, government shouldn't be doing this. We don't really need this heavy presence in government. They've gone way past every degree of sanity. And so there, eventually, some point that it's going to go too far and it's going to break the treasury market. So ever since that, it's understandable why people have said treasuries are going to die, treasuries are going to be blown up because the government has gone completely insane. But what nobody ever stops and thinks, historically, is that, yeah, the government went insane and treasuries haven't blown up. You think about when Bush started talking about TARP 2, was actually TARP 2. The federal government debt was roughly around $6 trillion, which at the time everybody thought, oh my God, $6 trillion, this is enormous. Since then, we've added $30 trillion in less than 20 years. We've gone from 6 to 36, basically. It's not exact, but 6 to 36. And what has happened to treasury prices and yields? Treasury prices have gone up and yields have gone down, especially when you account for the Federal Reserve's interference at the front end. The only reason that long-term rates went up over the last couple of years is because the Fed forced the short-term rate up. It wasn't because the market is repricing treasuries. And then when the government went insane in 2022 and 2023, everybody said the same thing. As interest rates were rising, that last little bit of higher for longer and inflation fear and the Fed hiking rates, everybody said the treasury market's going to blow up. And I said at the time, you go back, I just did this on YouTube. I go back to 2023. I said, look, 2 years not buying this. The 2 year especially saying rates are going to go lower, not higher. And of course, over the last almost year and a half since then, has it been a year and a half? Yeah, I guess it has. Year and a half since October 2023, rates have been going down again, not in a straight line, but by and large, they're going lower. The treasury market has defied all these predictions that it's going to blow up because people don't understand what the treasury market really actually is. And that's true of the basis trade as well. So no, I don't believe the treasury market's going to blow up. And I think what has been proven this month alone is that rates that went up earlier in the month was not the world rotating out of treasuries or rotating out of US dollar assets. That was never happening. It was simply that we confronted a major bout of deflationary monetary conditions, especially in the repo market, that first of all forced foreign reserve managers to sell their assets to try to deal with it. And the assets they sell are usually illiquid off-the-run treasuries, which starts the process and the ball rolling in the wrong direction as far as liquidity in that marketplace goes. And then the basis traders came in. And basis traders, I don't think necessarily were forced to sell, at least not in the beginning. I think a lot of them just sold because they weren't waiting around to be forced to sell, to lose their repo market funding. So rates were going up this month when they should have been going down. Everybody said, "Oh, rates should be going down during the liquidations of the stock market and everywhere else. Why aren't treasury yields going up?" And the fact that they're going up means that the world is rotating away from treasuries. So here is, at long last, it's a treasury market blowing up. And then rates, what did they do? They peaked once the dollar shortage peaked. It's got to a relatively stable equilibrium in the Eurodollar system, and rates went right back down again. It wasn't the treasury market blowing up. It wasn't people rotating away from the US dollar assets. It was a technical response to a dollar shortage problem that in the intermediate and longer term is treasury positive, treasury price positive, treasury yields going down. Deflationary money means longer run, lower growth and inflation expectations. Therefore, people are going to be buying treasuries because those are what matter, not this other narrative about government borrowing too much, or the politics, the partisan politics, the geopolitics of moving away from treasuries for all these other reasons. We keep going through these periods over and over again, and yet these same narratives keep popping up because, like I said, it seems like it should make sense. And by the way, I'm not advocating for this. I'm not saying this is a good thing. I'm saying this is the way the world is, and you need to make sense of it. I did a speech last year, I think it was, You told people that, uh, this is because this is how it is. You're kind of wasting your time thinking that you're going to wait for the treasury market to solve this problem for you. That's what it comes down to. Everybody wants the marketplace and treasuries to blow up to try to send a message to government and politicians and say, look, you can't do this anymore. And they've been waiting for almost 20 years for that message to be sent, and it hasn't been sent. So at some point, you got to say, okay, this is not the way to stop government from being insane. It's not going to be a treasury market blow up. Instead, look at the reasons why the treasury market hasn't blown up and understand what that right there is telling you. It's depression economics, low interest rates in the long run, low growth and low inflation. As long as that remains true, the treasury market isn't going to blow up. As much as we would like it to send a message for bond vigilantism to come back, it's just not happening. And so we do see these periods where treasury rates rise, but it's not because the markets are rejecting treasuries. It's because there are other issues that are consistent with deflationary depression economics that temporarily grab the marketplace, like in March of 2020, or go back to October 2008. People forget that. Long-term treasury yields were rising during the worst of that crisis. And it wasn't because people were rejecting treasuries or it was inflationary or anything of the sort. It was simply because foreign reserve managers, confronting with a nightmare dollar shortage, had to sell their reserve assets. That's really the issue what it comes down to. And it's only a short-run issue. So no, treasuries are not on the brink of collapse. We're just seeing another deflationary monetary event, and a pretty sharp one, which will lead to deflationary conditions or deflationary consequences or deflationary-like consequences in the real economy, which suppresses long-term growth and inflation expectations. Jonathan asks, is there a way to tell when the basis trade is done unwinding? I feel like it's been unwinding for some time now. We just don't have that level of information. I wish we did, but the regulators are asleep at the wheel. They have no interest in providing information, either to them, to their agencies and themselves. They don't find the information for themselves. They're simply content to sit back and look and say, well, the Fed has its tools. The Fed tells us this. The Fed tells us that. Therefore, we don't really need to know all of these things. Besides, this is the point that I always make, that the global financial crisis was not financial. By classifying it as a financial crisis, what that means is they're basically absolving themselves of responsibility here. They're saying this is something that has to do with the marketplace, and we, as capitalists and free market proponents, we step back and we don't try to interfere in the markets unless we absolutely have to. But if the problem that's coming out in these financial markets starts because of a monetary issue, which is the Fed is supposed to, it's in its charter, it's in the first paragraph, furnish elastic currency. So if you have a dollar problem, a dollar funding problem that leads to financial market chaos, which is exactly what happened in 2008, which is exactly why it was not a financial crisis, it was a monetary crisis. But as so long as everyone takes the hands-off approach, oh, that's just a bunch of financial stuff, that's the marketplace, that's, wealthy individuals and banks and hedge funds and all that. That's not our thing. As long as they take that position, we're not going to get information on this stuff because they say it's not our job. When it really isn't about treasuries, it's not about basis traders, it's about the monetary difficulties that create it. And in a way, when Jeremy Stein came out with his, really timely paper, and it wasn't just Stein, it was a couple other authors through Brookings, which advocated the Federal Reserve to create basically a hedge fund bailout specifically designed for the basis trade. What he was basically saying is, no, okay, hold up here. You guys want to absolve yourself of this stuff, but you can't, because this isn't strictly a financial thing. This is much bigger than you think it is. So what Stein was basically saying, and by the way, for people who don't know, Jeremy Stein used to be a board of governors of the Federal Reserve, one of the few that was actually worth listening to. One of the speeches that I always remember from Stein was back in 2013, a pretty interesting moment in monetary history. In 2013, he gave a speech where he talked about securities lending, the use of treasuries as a backstop for collateral swaps, and a whole bunch of stuff there. So Stein is not necessarily one of the good ones, but he's one of the least bad ones, let's put it that way. It's sort of like Janet Yellen, who at least was honest about what she didn't know. So for Jeremy Stein to come out and say, hey, we need to worry about this basis trade stuff, it shows the level of concern, though I do believe their concern is misplaced and misguided too, but at least it's thinking along the right direction. So is there a way to tell, Jonathan, that the basis trade, the unwinding is done? Sadly, what we're left with is just looking at the treasury market itself, the yield, and saying, okay, the yield was going up when it should have been going down, and now it's not going up and it's going back down like we think it is. Therefore, it's likely that the basis trade unwinding is done. And there's all sorts of contextual signals that say the same thing, right? When the basis trade was blowing up, we could tell it was the basis trade blowing up. Just look at the conditions that were happening earlier in April. You've got meltdowns in stock markets. You've got, all sorts of other indications that, the things were not going in the right direction, that there was difficulties in the monetary arena, which was leading to the liquidations and therefore illiquidity. You had repo signals, even if tangential, like credit spreads that were blowing up. That was going to be a problem in the repo market. There was going to be a problem for intermediation and collateral flows, and therefore dealers and everything said the conditions were ripe for something like the basis trade unwind to happen, and it did. It looked exactly like you would expect it to. Everything's melting down, and suddenly the treasury yields, which we expect to be flight to safety, were overwhelmed by selling for whatever reasons. And because it didn't seem to make sense, that's where everybody said, oh, everybody's ditching treasuries and rotating away from the dollar, when it was obvious that this was a basis trade reversal and foreign reserve managers selling. Even though we didn't see that in the Federal Reserve's memo, the data there, I still believe that was what started it all. But anyway, the context was there. Basis trade was unwinding earlier in April. Everything started to calm down by the middle part of April. Things settled down. It wasn't so immediate that, the world was melting down. And what happened? Suddenly treasury yields behave in the way that you would expect them to when you have this perspective. So that suggests, it's sort of a brute analysis here, but that suggests that the basis trade experienced the acute dollar shortage, repo market difficulties, and then settled down. And now everything is sort of back to where it was or where it should have been had there not been a basis trade. And I know, Jonathan, that the reason for your question is like that's a very unsatisfying answer. If we don't have enough information to say that, okay, what happens next time? Can we tell that we expect treasury yields to go down if we do go through another one of these events and suddenly they go up? That's a problem for anybody who's investing. And you expect treasuries to be your rock, your safety hedge, and suddenly they do the exact opposite. I know I had this conversation with my old colleagues at Alhambra in March of 2020. You do a lot of the 60-40 portfolios that you have for your a lot of investors, a lot of your customers, and the 60-40 portfolio. You got the stock market's melting down, and you think, well, you get some benefit from treasuries. No, the treasury market melts down. It's a major problem, which suggests that maybe you don't use treasuries for all your hedging, and that you need to look at other potential sources, which I think is the real reason for the question here. But no, we don't have any other information because authorities and regulators don't think it's their job to do it. Why are the frames behind you empty? Eddie, they're not empty. People have been talking about this since I started on YouTube, and only a few people understand few people know what's in there. A few people have been in this room, and I'm not going to say. I'll just let people's imaginations run wild with it. I think it's fun because what people come up with is more interesting than what's actually. What's actually there is important, but I think what people come up with is more interesting than what's there. Would you call the Fed a traditional finance meme, a TradFi meme? They are a meme. They certainly are. They're not a central bank. It's tough to get people to understand because this has been the framework. This has been deeply embedded in the psychology for a couple generations now. So the idea still lingers that the Federal Reserve is some kind of technocratic ideal. Like this is the place that even all the other bureaucrats in the government look to because they've been sold this narrative that the Fed is all powerful and is actually successful. People really do believe the jobs save bullshit. That the Fed saved the world in 2008 from being worse. When you actually look at what happened, is the Fed was just completely incompetent and irrelevant. But there is that ideal. And what I try to point out is this is a new invention. This was not the case for basically the entire history of the Federal Reserve up until the Great Moderation in 1980s and 1990s. It really wasn't the 1990s before this idea that the Fed was the reason for it really started to take hold. So for basically the vast majority of the Fed's history up until 1990s, the Fed was a joke. And nobody knew who the Fed chair. Paul Volcker was, his star didn't rise until long afterward because throughout the 1980s, people were not sure the great inflation was over with. That was, again, that was basically gaslighting or retconning the Fed into the Federal Reserve into the economic history and in great inflation history. That narrative was built in the 1990s. And so really it's only been from the 1990s, but I mean, I remember the 1990s, but that was 30 years ago. So it's been 30 years, a couple generations come along that have come along in this period where the Federal Reserve, at least what we're told, and really people don't have the time and expertise to argue otherwise. They've been told the Federal Reserve is this all-powerful institution. Don't question what it does. It has the printing press, as Ben Bernanke said in November of 2002, which was absolutely wrong and it was absolutely a lie, but that sold the narrative. And so people have bought the narrative that the Fed is this all-powerful institution for traditional finance when it never was. The history before the 1990s, and certainly the history of the 1970s and before, the 1930s, the Federal Reserve was actually sidelined after the debacle of the 1930s because everybody realized it didn't do what it was supposed to do. The entire purpose of the Fed was to make sure that something like 1929 didn't happen. And I don't mean the stock market. I mean the banking system's reaction to the stock market, which is what really created the Great Depression. There's a lot of misconceptions about what the Great Depression was and where it started. Stocks crashing did not cause the Great Depression. Stocks crashing caused, at the time, you have to remember to call money. Stocks were basically the subprime mortgage collateral in what was a nascent repo market. So you had money dealers that had to try to support stock brokerage houses, and that drained the system of liquidity, especially in the wholesale marketplace, which left the system completely susceptible to the bank runs that started a little bit later on as the economy started to really fall off in 1930. I'm getting sidetracked here, but the point is that the Federal Reserve, as Milton Friedman pointed out, and it took him 30 years to do that, the Federal Reserve at the very least didn't stop the crisis before it happened when that was the Fed's job. And so really, up until the 1990s, the Fed was a joke. It went from one failure to another, to another, to another. It went from the Great Depression. You had a little bit of stability in between, but nobody attributed that to the Federal Reserve. And then you had the Great Inflation. I mean, we have monetary difficulties that people are putting great in front of these terms. The Federal Reserve was always a joke up until the 1990s, and because nobody had a way to explain why there weren't bank panics anymore, why wasn't there deflationary money? What happened that led to this great moderation, which was spread success all throughout the world? Prosperity went everywhere. Maybe it was this. I mean, the Federal Reserve was forced to change the interest rate targeting. People didn't know that because the Fed covered that up and lied about it. But maybe the Fed, who knows? Maybe they hit upon some secret. And I was working in financial services in the 1990s as a young man trying to break into this business, and people in financial services loved that idea. The idea was that there was this great technocratic guy, Alan Greenspan, who could control the economy and make everything good, which meant for financial services, everybody could buy anything. And you wouldn't have to worry about the economic consequences because there was this guy, Alan Greenspan, who had everything covered and under control. So you can see why the narrative sold easily to financial services, and then it spread from there. It served a need where financial services professionals could say, I don't need to care about the economy. Greenspan's got it covered. Just buy stocks or buy whatever junk that I'm going to sell you. As far as, it got increasingly junky in terms of even institutional buyers buying subprime mortgage products and things like that. That's where it all came from, the narrative of the Fed. So Marley, is it a meme? Yeah, it's been a meme its entire existence, and really it was in the 1990s too, just that people didn't realize it because they were told a story that seemed to make sense for a while. Happy Saturday to you too, TC. Markets always go up, Jeff. Yes, they do, except when they're confronted with the traditional recession, then they go down, which is what we're getting into here. Is this a traditional recession or is it not? I mean, really, you go back to 2022, what happened then? The market sold off. The same thing, it was a pretty substantial sell-off. It wasn't straight down. There wasn't a whole lot of liquidations, but the market sold off, pretty substantial correction in 2022 because two things: the perception of interest rates rising, which people are taught to believe that rising interest rates are somehow bad for stocks, which goes a bunch of other narratives and myths that fed that. And also, the world was worried about possible traditional style recession in 2022. Remember, we had the technical recession in the US in the first half. There was a sharp slowdown. The oil price shock was not going to be good. But what the market saw by October and November, as the world shifted into forgot how to grow recession, In the stock market, that was, oh, this is not a traditional recession. We're not going to see a huge increase in unemployment. And so everybody started to buy all over again. Plus, that was the arrival of the AI bubble, which supported that as well. But if you remove the traditional recession downside and you have these other things, plus the prospect that over 2023 that the Fed would stop hiking rates, there was a reason for everybody to go back to buy again. So yeah, stocks always go up, but they go up until they get to that recession case, and then they start to sell. That's when they start to sell. You're going to do a live debate with Gammon's Train GPT live. I'm not sure what you referred to, but I'm not surprised George will be playing around in AI. He's always cutting edge. Seems markets want to react when data says unemployment is low, but ignore GDP when recessionary. Like I said, I think that's the markets have shifted, and that in and of itself is a key critical signal for stocks. The fact that we went from trying to evaluate data, is it good enough to be consistent with the soft landing scenario? And if it's not, then we'd be a little bit concerned. To now is that everything has changed. So, okay, we realize that, we're in a pretty serious shape here, pretty serious condition. So is everything bad enough that it's going to confirm the worst case, what the market thinks is the worst case recession? So unemployment is one of the key triggers. GDP is as well, but as you can see, GDP is easy to rationalize away when you give people a reason to do that. GDP was only negative because imports soared. Like, yeah, okay, but as I said in the intro here to this Q&A, but that just means there's going to be a huge payback. If imports soared by historic proportions, they're going to be no imports basically in the second quarter, which ironically means that second quarter GDP will be boosted by imports coming back down. So you could see a small negative in GDP in the first quarter, and then a pretty substantial payback in the opposite direction, depending upon how big of a payback there is going in the other direction in terms of consumer spending, because that's the other side of it. The argument you can make is, okay, yeah, imports were up and that caused a contraction in GDP, but consumer spending was up, especially in March, which caused GDP to be higher than it otherwise would have been, which means there's going to be a payback in consumer spending, which could very likely be bigger than the payback or the pay forward in imports. So imports will raise GDP in the second quarter, but if there's a sharper payback in spending, that means GDP could actually be negative. So, you can get yourself tangled into knots over these, artificial distortions and entanglements. But if everything still early in the process for payback, still early in the process for the tariff shock, whatever that's going to be, the market's reaction is really about, since we realize the situation has shifted and that there's more downside risk, everything is shifted to, do we get confirmation of the downside cases? So that's really where everybody's focused, and anything short of confirmation, whatever that actually means, that means that the market's going to take that favorably. So numbers that would have looked unfavorably in the soft landing scenario are now taken to be favorable in the recession scenario that we're starting to confront more seriously. So yeah, markets are going to take everything and ignore everything that isn't the worst case for the next little while. We'll see how long that lasts. My faith in recession, this is Wild Boy. My faith in recession lies in the boats down 35% and oil prices down 50%. Well, the 50% in oil prices, you may get that. The video that I'm putting out today for YouTube, I show the correlation between WTI and interest rate swap spreads, particularly the long run. Because just like treasury yields, interest rate swap spreads, there's a really good correlation with oil prices, especially post 2013 after, we got through the supply shock in the early part of the 2010s. Oil prices and swap spreads are actually they correlate pretty strongly up until the last couple of years when OPEC interfered on the supply side. So my point is, if you look at oil prices from the perspective of interest rate swap spreads, like nominal treasuries that were interfered with by the Federal Reserve, what swap spreads suggest is that oil prices, like nominal treasury rates, should be much lower. Fundamentally, the economic conditions longer term do not support oil prices that are up around, certainly not $80, certainly not $70, but maybe 50, 40 and below. That's what swaps suggest. And I'm not saying that the swap market, there's a mechanical relationship between swaps and oil prices, or even, swaps and nominal treasuries. What I'm saying is that what goes into the swap market, which is basically everything, people don't realize how important, how much information there is from interest rate swaps, because it reaches everyone. Everybody's in the swap market. It covers the entire world. It's the deep, really key part of the reserve currency system. So it's global. Everybody's in it. Massive amount of knowledge, deep, liquid. We're talking about hundreds of trillions in contracts. And so the swap market basically gives you a lot of information about what people are seeing as far as the long run background for the entire global system. So if the swap market is describing a long run potential for a global system that is pretty ugly, chances are that oil prices, for one, and nominal treasury yields for another, are going to reflect that ugliness at some point in the future. It's not like the swaps go down and you're buying swaps and selling oil. There's not a mechanical relationship. It's not a direct relationship. It's the swap market is describing the background, the longer term background that all these other financial markets and the macroeconomy in the short run has to work with them. So if the swap market becomes increasingly pessimistic with decreasing spreads becoming more negative, that means a really big part of the monetary system, the financial system too, is pricing for scenarios that are not conducive to oil prices remaining where they are. And so the swap market has said pretty much all along, and there's a really good correlation. Oil prices peaked in May of 2022, swap spreads peaked in May of 2022. Because the swap market began to pick up on the oil price shock, the price shock, the forgot how to grow economy. And while OPEC has tried to interfere in oil prices to hold it higher this entire time, now that OPEC has thrown in the towel, which is one of the biggest developments this week that nobody's talking about, OPEC has given up on its supply side tactic to support oil prices because they realize in a recession period, there's no sense of doing it. They're only going to continue harming themselves. So oil is starting to more and more reflect the fundamentals the swap market has been pricing all this time. So if your faith in recession lies in oil prices down 50%, the swap market says you were going to be betting on that for the last couple of years regardless. And all it was going to take is for OPEC to finally see the light and start to get out of the way, which is exactly the same thing that we're talking about with the Federal Reserve and interest rates. The swap market has been saying the treasury yield, look at the 10-year treasury yield, the fair value, I hate to use that term, but the fair value of a treasury yield, given the constraints that the swap market was seeing, was somewhere around 2% or less. So what the market was saying is that over time, like OPEC, the Federal Reserve was going to see the light, get the hell out of the way, stop interfering in the short end of the curve, and that the treasury yields were likely to settle much lower, given enough time to do so. And that's always the part that people hate, is given enough time, because we don't know how much time there is, nor does that really tell us much about how we get from A to B. So the swap market says rates are going to go down and stay there, but what does that actually mean? That's what we have to figure out through context. That's really all that the swap market tells us, that rates are likely to go down and stay there. And the more negative that swap spreads get, the more confidence there is in that scenario, the more we should expect rates to go lower and the longer we should expect them to stay there. But what does that actually mean? We don't really know. But what I've been pointing out last year or so is that everything that has happened over the last year is consistent with that eventual outcome. If you were picturing going from the supply shock high to a long-run future where rates are low and stay there, this is what you would imagine. Maybe not necessarily spaced out over this long period of time, but you would imagine that the market would say, okay, first of all, we have to solve the inflation problem, which is basically to get people to see there was no inflation. It was simply a supply shock. And supply shocks do take several years to run their course. And once they do, what happens then? Well, then the economy starts to look weaker because it was never recovering in the first place. We have to get people to realize it was never strong and resilient. It was forgot how to grow at the very least. And by the way, forgot how to grow is simply my term for recession, a different kind of recession than people are willing to accept. If I use the term recession for the last couple years, people immediately ignore it because they're conditioned to believe that there's only one kind of recession, and it looks like every post-war recession up until 2007. When an honest review of 2007 and afterward would have seen that there are different kinds of recession, in fact, more like a depression. But either way, so forgot how to grow is a euphemism that I use, so I don't have to use the term recession, which immediately turns people off because they have prejudices and predetermined expectations. So we have the forgot how to grow economy, get people to see that. So we go from not inflation to not strong and resilient to what comes next. If we're on a path to low interest rates over the long run, that's the progression we would expect. From not inflation to, okay, the economy's not strong and resilient, to what comes next? Well, something that maybe looks like a recession. Maybe it's something that looks more like a traditional style recession. So everything that happens is happening in a way that you would expect if we're moving in that direction that the swap market is priced. And it includes nominal treasury yields that are going lower, not higher. It includes oil prices that were overpriced to begin with. They're going lower, not higher. And so things are starting to fall in line more concretely in a way that people can see it, which is why we're having this reaction to the recession question in the marketplace, even the stock market, because the world is moving in that direction, however, incrementally and slowly. So if your recession faith lies in oil prices, oil's moving in that direction. People need to see it. Trump has burst the COVID bubble. Markets will go down to 2020 levels before they head higher again. That's never make predictions because they're guaranteed to be wrong. I'm not saying, Manny, that you're not wrong in your thinking. It's just that, the COVID bubble, that part of it, I absolutely agree with. And I've said this entire time that, you can't just turn off the economy and then turn it back on and think everything's going to be fine. Or that if you even if you agree that things won't be fine, that you can just throw government money at it and it will make it fine. I mean, there's so much arrogance in those types of beliefs, which, Keynesian economists, what do you expect? But the idea was we can shut everything down, turn everything back on, and what we did destroy in the turning it off, the government will fix it by transferring money, which is basically just an enormous distortion. And what came out and what ended up being was, we impoverished the entire world with price changes. Jobs never came back. Incomes didn't keep up with prices for the vast majority of people. Some people really did well, but some people always do well. So we left way too many people behind, and the idea that was going to lead to some type of strong, resilient recovery from here on was just completely fantasy and fiction. So the last couple of years, the forgot how to grow style recession is nothing more, when you really look at it big picture terms, it's nothing more than the economy transitioning from the fake recovery of the early 2020s to the long run potential, which we still don't know. We still really don't know what that looks like, but we know it's not good. It's not really consistent with the soft landing that people have in mind. We've been transitioning from one part to the other part. That's really all that's been happening over the last couple of years. And as I showed in my webinar from, last month? I think it was last month. The forgot how to grow economy, you can find it everywhere. You have the recovery in real terms that was starting, I should go this way. You had recovery in real terms that was starting in 2021 and into 2022. 2022, everything changed. It didn't look like the recession, and we talked about this with the stock market reaction to it, but it's as if the recovery just stopped. And that was the transition period. That is going from the high to the long run stable equilibrium, where that long run stable equilibrium reflects the realization, the fact that we did a lot of harm to the global economy, the US economy too, during the pandemic and the lockdowns, long run harm, potential that was harmed, that the governments tried to paper over for as long as they possibly could, but you can't inorganically solve an organic problem. And the organic problem is the economic system forgot how to grow. It's literally the truth. It didn't forget, it was forced into that shape. So set aside the partisan politics. It's really just we've been moving in that direction all along, and that as we get further along in that process, more and more people can see it because it becomes more and more obvious. When Europe, for example, Europe is supposed to recover every year. Every year, everybody says, "Oh, the Europeans they had a downturn in late 2022. 2023, they're going to come right out of it." Well, 2023 they did. Okay, 2024 they're going to come out of it. 2024 they did. 2025 they're going to come out of it. 2025 they're not going to. Eventually, people, after all of these false dawns, people start to get the notion that okay, something big is wrong here, which is why we had so much political upset over the couple of years. Saving my coffee grounds used 3 times minimum and buying day-old donuts. Yeah, that's a good way. Isaac asks, is long TLT a good play? How soon until shit hits the fan? Feces and fan blades. Yeah. TLT, any type of treasuries durations, you get into the more we move toward the long run scenario pictured by the stock market, the more In the short run, markets will correspond with that long run view, which means that lower growth and inflation expectations, therefore lower treasury yields. And treasury yields have been trying to go lower, and the Federal Reserve keeps trying to get in the way and interfere with them for its own ridiculous purposes, even as the rest of the central banks around the world, or at least the vast majority of them, they're already racing to the bottom. They're already cutting rates. They see the writing on the wall, and eventually the Fed will see it too. So the treasury market, you've got the bull steepening case that's still in play, including where longer term rates actually rise in short run periods. You go back to 2008, the worst parts of 2008, which are late 2008 and early 2009, you saw massive bull steepening, classic bull steepening in the treasury market, the German market and other bond markets, Canadian market. But what that meant was short-term rates went down a lot because that was the short-run conditions in the marketplace, everybody driving to safety and then recognizing the Fed wasn't going to get in the way, the Fed was going to cut rates too. So short-term rates went down a lot, long-term rates went down, and then they kind of leveled off. And for a while, during the worst parts of the crisis, long-term rates started to go slightly higher. And it wasn't until after it really started to finish and people started to see the long-run consequences to what was not a recession that longer-term rates started to come back down again. So the bull steepening wasn't all at once, and it wasn't where all interest rates go down at the same time and in the same way. You have this variation and variability on the curve itself, which is not surprising because the curve is really several different curves, kind of mashed together into a single whole. Longer run, the short term, then you got the middle part. So you don't really ever have harmony in the treasury curve anyway, which is why you look at the treasury curve and analyze changes in it, because that tells you something about each of these different parts, what they're doing. But you look at the treasury curve right now, what you see is this very clear bulge right around the 2-year to 5-year spot in the curve, right in the middle, which is classic recession bull steepening case. And so the 2-year bulge means that the 2-year rate, the middle part of the curve, is going down farther than the longer term rates. And longer term rates have been higher, which is not inconsistent in the short run for even recession, even the worst recession cases. So to answer your question, Isaac, is TLT a good long-term play? Yeah, but it's not like you can just buy it and everything, prices go up, the yields go down, and it's just a straight line. Nothing ever goes in a straight line. But what we're saying is that over time, these various pieces in the yield curve work out in the way that they do in classic bull steepening fashion. Over time, this is why people have this in mind, this idea in mind that treasury rates just go down, because over time that's what it looks like. If you're not aware of all these short run changes in the curve as it moves down, if you just look at it at the end, it looks like rates just went down in sort of like a straight line, but that's never the case. So as the Fed starts to act more like central banks around the rest of the world, that eliminates the interference at the short end. And if the economy continues to develop in the way that it seems to be, then the long end, when it decides to, will start to go down a little bit too. But it's really more the front in the middle, that bulge in the middle part of the curve, where that happens most. Why do we believe government data? Because we don't really have a choice. I know this is a problem that comes up all the time. In fact, I just did my deep dive analysis yesterday on the payroll report, just to show that there's every reason to believe that payroll data is overstated. And it's not just me saying, I don't agree with the payroll data. There are legitimate reasons for these reasons why you think that the payroll statistics are overstated, which is why they're always revised lower. It wasn't partisan. It wasn't like the BLS was saying, hey, we got to reelect Biden, therefore we're going to overstate the payroll report, because now they're doing it in the Trump administration too. It's not partisan politics. It's the fact that the way that these statistics are created and the way that they were developed, what they're trying to do is inconsistent with the economic environment that we have for today. It's really, again, it's the recession question. We're given this idea that there's only 2 states for the economy. It's either growing or it's a recession. And there's nothing in between. What forgot how to grow style recession is sort of in between those two. So the statistics that we have, there's reasons to believe that, yes, they're overstating the labor market case, which is another way of saying, why do we believe the government data? And the reason we believe the government data is we don't believe it full faith. We don't say, okay, I'm going to take this number at face value. Never take anything at face value. So you look at the payroll number, you look at GDP, you look at the JOLTS survey, you look at the household survey. Then you look at ISM, you look at private sources of data, you look at all of the stuff that you got that's available, and there's a lot of it. And that's the pendulum on the other side of it. Do we have too much data? So you look around and say, okay, I don't trust the payroll report. And even, by the way, the BLS says don't trust the payroll report too. You have to understand that the monthly payroll numbers are a statistical estimation for a confidence interval that is exceptionally wide. I don't think people realize how wide that confidence interval is. It's like plus or minus 100,000. And it's only a 90% confidence interval too. So what they're saying is don't fall for a single monthly data point. And you shouldn't fall for a single data point to begin with, because they have there is no way to be precise. And so we're dealing in very rough terms to begin with. So if you understand that we have data that isn't precise, that's really just rough approximations, what we're basically saying is, okay, the government data on labor is a rough approximation of labor. Then we have another private source on labor that's a rough approximation of labor. And if those two kind of look like the same thing, not exactly, but they're kind of doing the same things at the same time, we don't need to be precise. We can say, okay, both of these things, and there's a third thing over here that looks the same way, then yes, okay, that makes sense. And it's likely the general interpretation of all three of those things is closer to the right one. You're never 100% sure, but you're reasonably assured, which is why you never really saw most people questioning statistics before 2008, because when the government came out with a payroll report that was generally strong, especially during the 1990s, people thought, you didn't question it because, okay, even though this is just a rough approximation, it fits with our perception of what the economy is doing in the 1990s. So why do we believe government data? Okay, I don't believe government manipulates the data. I think what they have is they have enormous difficulties in the 2010s environment that was made worse by the 2020s environment. So they have enormous difficulties trying to make that rough approximation for what they think their specific part of the economy is doing. That's really the problem here. And it breeds all of these other theories that, okay, the government's cooking the books for their own partisan purposes, when that's so very clearly not the case. Governments are struggling with the economic circumstances just as much as the economy is. And in one way, that fits with the overall context that we're talking about here. The more the government struggles with its data, the more that aligns with our interpretation of an economy that's struggling in a monetary system and the financial system as well. So my advice here is take the payroll report and say, okay, this is what it seems to look like. We'll analyze it and really look at the details because those are important too. But let's put that in a wider context of this thing over here, and then this thing over here, and then this thing here, and then the global context, because this is globally synchronized, by the way. And we'll see how all of these things start to fit together, and if there is some general agreement between all of these rough approximations. When you do that, it's much better. You don't have to worry about is the government cooking the books or not, or any of the other statistical problems, because you have a broad enough survey that you're reasonably sure that you have somewhat of a good idea of where you think things are going. And then, actually, before you even get to that, you've already got your market interpretations. Like I said, the background, even the swap spreads, as much as I rely on them, you don't take them at face value either, because markets are volatile. They move back and forth. That's just a place to start. And then you build a contextual, a mental roadmap or a mental map of what the markets are doing. Does that fit with the macroeconomic statistics? Do you have context there? So we're really trying to put all of these pieces together, not just look at the 177,000 for April payrolls and say, wow, things are strong and resilient. That's not what we're doing. You never take these statistics at face value. So in one sense, we don't believe the government data, but we also understand that what the government's trying to do with that statistics is not influence public opinion so much as just trying to produce something that looks like a rough approximation. Let's do one more question here. Saved cash accordingly, K180108, is that one or that's an L? Okay. Yeah, rolling treasury bills for the last couple of years has been rewarding. I've done exactly the same thing. Little risk, decent return, highly liquid, can't go wrong. But the problem is, in this environment, treasury bill rates are going to go lower. That's one positive for the Fed's interference, is that it's made treasury bill returns relatively decent. Supply chain expert Mr. Peterson stated in the Wall Street Journal that tariffs are an extinction level event. I don't know who Mr. Peterson is, so I really shouldn't comment on this. I don't agree with that. I think a lot of this, and there's a lot of fear mongering over tariffs, has to do with, again, a misinterpretation of the Great Depression. There are still a lot of people who, to this day, believe the Smoot-Hawley Tariff Act was the reason for the Great Depression, that tariffs are a bad thing and it can create an absolute catastrophe. That's not what created the Great Depression. They didn't help. And I also say I'm against tariffs to begin with. I've said this before on the live Q&As. I've said it in other venues too. I don't like tariffs because they're a form of central planning. And I know the counter argument. The counter argument is, well, there is no free market. It's not real. Other governments around the world are interfering in their markets. So this is just us finally leveling the playing field. And I agree with that to an extent, but I think that's an overstated case too, because even if it was true to the extent that people support that argument are making, you see that when the monetary system and the economy is actually working the way it should, even though it's not a perfectly free market, even though the level playing field isn't completely level, it is basically level. The prosperity from globalization, you can't argue with it. I know people will try. They'll say, well, look at the hollowing out of the U.S. manufacturing base. Yes, that was the trade-off. Economics, small economics, is always about trade-offs. And so the U.S. traded its manufacturing and industrial base for a level of prosperity around the rest of the world that has been unparalleled in human history. And there's nothing that says that we can't do that again, but we need to identify the reasons why it stopped and how to restart it. Now, and again, I understand the America First idea is that, okay, if the world economy isn't going to be the way it was before the 2008 crisis, then we need to at least take care of our own first, which you can't do with the industrial manufacturing base and all the jobs that went with it have disappeared. We need to get those back. I understand where all that stuff is coming from. What I'm saying is that tariffs are still a form of central planning that are at the very least a third level of response to it, trying to apply a Band-Aid to a gaping global wound. So they're not going to be a panacea, even in the long run. And whether or not they create short-run extinction level event, I don't think that's the case at all. There's going to be disruption. There's going to be some harm done to especially export-oriented economies, more so from the distortions over tariffs than actually the tariffs themselves. I think we're seeing that already in places like Japan. But extinction level event from tariffs, no, I don't agree with that. I don't like tariffs to begin with. I understand why they're being applied and what the goals are. I don't think they'll be reached. I think it's still way too much central planning for my taste. And I would prefer to try to put the economy back together, not Humpty Dumpty style, by changing what needs to be changed so that we can move forward from this point on. So I don't know who Mr. Peterson is, but if he's a supply chain expert, I think that what that really shows is that there's going to be disruptions to it, which I think most people realize, and that's certainly going to be the case. What the market reaction to that possibility, why it was so violent, is because the background of swaps and other markets, even the Treasury curve has been saying, by being averted, the economy, the monetary system, the financial system, they were all fragile before we even got to tariffs and trade distortions. So it's not the reaction to trade distortions as it is one more negative that gets applied to a fragile economy can potentially break it down in a really serious way. That's what the market reactions are. And that's what got the narrative shifting from is data good enough to confirm the soft landing to is data bad enough that it confirms the worst possible cases. So that's fragile economy, tariff shock, not a good combination. That's where the violent reaction came from, not that tariffs are going to be an extinction level event. That's my opinion of it, and that's my reading on where we stand. So let's leave it there. What was this, Q&A 144? Again, thank you all for joining me. The questions that are left, I will remember to download, and I'll do the pre-recorded Q&A this coming Tuesday. I'll try to answer as many as I possibly can. There's a lot of them. So maybe I'll do a rapid fire thing, which is, as you know, that's not something I do. I tend to meander on with these questions pretty long. So I'll try to do a rapid fire response to all these questions, but thank you very much for joining me. I'll see you all again for a live Q&A, I think the week after Tuesday. But until then, everybody take care.